On to one that could be a screaming buy, and we will say this at the end if it is or not, because we'll check into it for you. Jack in the Box is a company. And I got to tell you, Jack in the Box was the first, and again, the corporate office I worked for, first came to San Diego back in 1983. Remember, I made $8,000 a year. That's all I was making as a junior accountant then. So, but I had a little affiliation with the company. I did buy the stock over the years, made some good money from the company. But let's talk about it. So Jack in the Box, their symbol is JACK, Jack. In the restaurant industry, short 32%. There's some problems with this company, so we got to find out what they are, because it could be a screaming buy or it could be a value nightmare here. So, well, they have no earnings, no PE ratio. That's not a good start. The industry's at 31.1. Price to sales 0.2 versus 2.5. That is a positive, but no price to book value, which means that the liabilities exceed the assets. That's not good. Price to cash flow 2.3 versus 17.4. They do have a good PEG ratio, 0.6 versus 20.7 for the industry. Now, for the 1 year, there's nothing on the earnings growth, so it's probably negative. I guess they have no earnings maybe the last 24 months. The industry was down 3%. Sales for Jack in the Box, down 6% versus 6.5%. My excitement's waning here. 5-year estimated growth on the earnings from the analysts, 6.5% versus 6.4%. Now, they do pay a 10.2% dividend. Now, before you run out and buy the stock, I would have to guess that it's probably going to be cut, if not eliminated.
I, without even looking at the numbers, am 95% sure that dividend will get cut. Yields don't get to 10% without concern.
Yeah. And there's something here which we haven't found yet what the problem is yet. Let's see. The payout ratio, nothing there. Free cash flow payout ratio, 114%. So they're using a lot to pay that dividend out. Look at the balance sheet. Current ratio, 0.5 versus 1.1. So they're really lacking liquidity, and that can be a problem. They could be forced into bankruptcy without liquidity because they can't pay their bills. So that's a problem. Let's see. Net profit margin, a negative 13.7% versus a positive 8.3%. Return on equity is very good, though, 21.4 versus 378. Free cash flow is only, I guess, $30 million versus $2.8 billion for the industry. So I don't know what the problem is yet, but I'm going to look at the financial statements while you're giving us the numbers going forward.
Yeah, and I'll give the current price here for Jack in the Box first. It's $17.25. I'm going to let you pull this out, but you had the high for Jack in the Box or something in terms of their stock price. Didn't I see you jot that down?
Yes, I did. The high was $115 on May 2021.
Wow. Yeah. So it's definitely fallen a lot. I mean, their 10-year return down about 80% over the last 5 years. That stock has fallen 75%. Over the last 1 year, it's down 66%. So a lot of these issues have really come about within that last 1 to 3 years, I would say. And one thing I always forget about with Jack in the Box is they actually bought Del Taco in March 2022. They announced the deal in December 2021. So everything was flying high in 2021. Yeah. And then they announced this acquisition, which I thought was kind of strange to begin with. But it appears like that integration is not helping. Stock has just been decimated since then. But looking at the numbers, I mean, you look purely at valuation ratios, which, again, you always got to be careful when you're a value investor. You don't want to fall for a value trap, and maybe Jack in the Box is, because the valuations look great. I mean, you go out to September 2026, estimated earnings per share here, $5.14. It gives you a target sell price at $85.32. It trades at 3.3 times those future earnings.
How many analysts is that?
20.
What is the high and the low estimate?
The high is $5.55 and the low $4.50.
That's because I would say
it's relatively tight, I'd say.
Yeah, and you use the lowest one, you still get a target price of probably 70.
Yeah, I mean it's still, let's see, you're still going to get a target sell price of $74.70 if you use the low. So I mean the valuations look phenomenal on this, and I mean personally I like Jack in the Box. I know you had the affiliation when you worked at Food Maker.
Yeah, Food Maker was a corporate name. Yeah,
but I mean Jack in the Box was probably my favorite restaurant. I remember you used to take me there, and we used to get the ultimate cheeseburger when I was a kid. And then the milkshakes were always really good in the Jack in the Box. And even when I went to college, remember they had they're called munchie meals.
Right.
And that was their late night menu. And you would get like a cheeseburger, 2 tacos, and curly fries for like $5 or something crazy. But I love Jack in the Box. I haven't eaten there in a while because my wife tries to make sure I eat healthy now. But
Jack in the Box is healthy.
that's a hard one to spin. But I think there's potential here if you can understand what is going on with these problems.
Yeah, you got to find out what the problem is. And I do see that they do have about almost $3 billion of debt. Their equity is a negative $976 million. Balance sheet is kind of weak. They don't have much cash. They got about $16 million, it looks like, in cash. I know that they are, I appear, because they used to be the corporate headquarters was on Balboa, and I forget the cross street there. But I drive by there after doing my TV segment on KUSI, and it's completely torn down. They're building some massive building. Now, I don't know if they sold that, or is that Food Maker now, Jack in the Box, that is actually doing that. But
did they move? Yeah, because I know exactly. It used to be right over there, and was that Kearney Mesa?
Yeah, Kearney Mesa. And we can't get it because it's too small. I think the market cap now is like $300 million. But I think for a smart investor to do the research and find out what is the problem here, because the analysts don't seem to be worried about it. The debt, it's a little bit high, but this could be a runaway train here that does very well with a lot of risk on it.
And it looks like the address is still 9357 Spectrum Center Boulevard in San Diego, which I believe is where it was, or at least it's still in that same vicinity.
Yeah, it used to be on Balboa.
Okay.
I think it was like gosh, we're talking about 40 years ago. I think it was like 9,330 or something. I don't know.
Yeah,
right across from Cubic Corporation.
And I think it, as you said, it's too small for us now. But how do I say this? If I was a risk taker, I think this would be very intriguing because that balance sheet is a problem. Jack in the Box could file bankruptcy before the company turns around.
Yeah.
But if not, I mean, the earnings power there, the cash flow power is there. It's just a question of can they get that debt situation figured out? If they can't, they go bankrupt. If they do get that debt figured out, I mean, shoot, yeah, this could go back to 80, which would be a huge return for you.
Yeah, and the trailing 12 months, they do have net cash provided by operations of positive 144. So that'd be probably $1 million. So there's, if we didn't manage $700 million, I'd say, gee, we should maybe look at this a little bit deeper. But
we couldn't. The debt. I mean, they have no equity. I mean,
that's true.
There's too much risk in it for the way we like to manage money. That's what I'm saying. If I'm like, I'm feeling like a little bit like I want to go to Vegas today, maybe Jack in the Box would be a good gamble.
Yeah.
But that's not how we do things.
There could be more to it. Again, for the other investor, we can't do it, but you as the investor could. Find out what the problem is. I mean, read the news on this. Read the last conference call. What is going on? Because it may be a fixable problem. Then you'll be fine. But
I think you have too much affinity there because you work there. I think
I do. I think you're right. I'm not going to argue.
I don't think I would buy this stock. I mean, it doesn't fit the way I invest money.
Yeah.
We invest money.
I know, because we are more conservative, but it just I think there is a little bit of love for that
I
company.
just know if they filed bankruptcy and went to zero, be like, we knew it. This is exactly why we don't buy companies like this. You're chasing a dream.
I still remember the CFO, Chuck Duddles, took me to lunch one time, and we talked about the chocolate milkshakes made from real ice cream. And I was just so impressed, like, wow, the CFO took me out to lunch. All right, well, let's move on here. Okay.